You're not losing trades because your setup is wrong. You're losing because your own mind is setting traps you can't see. Every chart looks clean until emotions take over. Every plan sounds solid until the market moves against you. And that's exactly what we're exposing today. The 5 silent psychological traps that destroy more trader accounts than bad entries ever will. These aren't just mistakes. They're invisible habits that keep you stuck, losing, and frustrated without even realizing why. Let's break them down before they break you. Stick with me, because once you recognize these patterns, you'll never trade the same way again. And if you think this doesn't apply to you, it probably means you need it the most. Before we dive in, one quick ask. Many of you watching these videos are growing, improving, learning, but still not subscribed. And that could mean missing the edge that changes everything. So if you're serious about mastering trading psychology, smash the like button to help this reach more traders. And hit subscribe so you never fall into these traps again. Number 1, revenge trading. When a market becomes your personal battlefield. Every trader has felt the sting of a brutal loss, that sharp, sinking gut punch when a stop loss gets hit, or a perfectly good setup breaks down without warning. And in that moment, the trade becomes more than just a trade. It becomes personal. Revenge trading doesn't start with strategy. It starts with emotion, anger, shame, or even fear disguised as confidence. It's that voice in your head that says, "I'm getting that back." And instead of stepping back to regroup, you rush into another position. You double your size. You widen your stop. You throw risk management out the window because you're no longer trading probabilities. You're chasing redemption. But the market is emotionless. It doesn't know you're hurt. It doesn't know you're trying to recover. It doesn't even know you exist. And it certainly doesn't care about your revenge. Revenge trading is like playing poker after a bad beat. Emotional, tilted, and desperate. It converts a single loss into a cascade of poor decisions. One wrong trade turns into 3. Your account bleeds not because the market was unfair, but because you couldn't step away when you should have. The real test isn't how you trade when you're winning. It's what you do right after you lose. Number 2, premature entries. When your patience breaks before the chart does. Impatience is one of the costliest habits in trading, and yet it masquerades as intuition. You see a candle pushing up fast, rejecting a level, and your instincts scream, "It's happening. Get in now." But the candle isn't closed, the move isn't confirmed, the data isn't complete. And still you jump. This is the psychology of impulse over process. The fear of missing out mixes with the thrill of action. You think, if I don't act now, I'll miss the move dash, so you enter early, only to watch the candle flip, reverse, and close against you, leaving you trapped in a trade that looked great for 5 seconds and terrible for the next 15 minutes. The truth? A forming candle is a half-told story. Its shape can deceive. Its momentum can stall. Until that candle closes, its narrative is fluid, and trying to predict its outcome is like placing a bet before the race even starts. Great traders understand that confirmation isn't weakness, it's discipline. The ability to wait for a candle to close, for a level to hold, for a pattern to complete. That's what separates amateurs from professionals. Jumping the gun doesn't make you decisive. It makes you vulnerable. Number 3, 1-minute time zones. Building your house on shifting sand. The 1-minute chart is seductive. It moves fast. It keeps you busy. It gives the illusion of control. But trading off ultra-low time frames is like trying to navigate a hurricane with a paper map. You're reacting to noise, not reading structure. When you draw support and resistance on the 1-minute or 5-minute chart and treat them like concrete levels, you're setting traps for yourself. Those levels are shaped by short-term emotion, not institutional logic. They might look clean, wicks respecting zones, candles bouncing perfectly, but they collapse the moment real volume enters the market. Why? Because professional money doesn't care about your micro zones. They're trading off daily structure for hour confluence and multi-session liquidity. not 60-second emotional blips. Staying zoomed in keeps you frantic. It pulls you into over-trading, constant doubt, and endless second-guessing. You start thinking every flicker matters. You abandon your plan to chase micro-moves, and before you know it, your edge dissolves. To win, you need to see the battlefield, not just the raindrops. Zoom out. Anchor your decisions in context, not chaos. The broader structure gives you stability. The lower time frames are only tools, not your foundation. Number 4, predictable stops, playing chess with your king exposed. You've been told to place your stop loss just below the last swing low or just above the previous high. It feels disciplined. It feels logical. It's what the books say. But here's what they don't say. If everyone's using the same playbook, it becomes easy to beat. The market is a game of liquidity, and your stop loss is a beacon. It tells the market, here's where I'm vulnerable. And large players, algorithms, and liquidity providers, they see that. They hunt it. They design moves that sweep predictable stop levels, trigger panic exits, and then send price flying in the original direction. So you were right about direction, but wrong about positioning. You get wicked out, the chart reverses, and now you're left watching the move you called from the sidelines. Strategic traders know how to hide in the flow of uncertainty. They understand that stops need to be protected. Not just mathematically, but psychologically. You don't want to be where everyone else is. You want to be just outside the obvious, where the pain threshold is higher, but so is the survival rate. Think like a sniper. Be invisible. Predictable stops aren't safe. They're bait. Number 5. This time is different. The most dangerous lie we tell ourselves. This is the most destructive lie in trading. I know it didn't work last time, but this time will be different. It's not said aloud. It's whispered. In that quiet moment before you break your rule again, you ignore confirmation. You size up. You chase late. You violate your system. And somewhere in your mind, hope kicks in. Maybe this time it'll work. But nothing's different except your willingness to ignore the lesson. The market hasn't changed. The structure hasn't changed. Only your discipline has weakened. This trap is so deadly because it's disguised as optimism. It makes you feel brave. But real courage in trading isn't doing the risky thing. It's sticking to your process when every fiber of your body wants to break it. Successful traders evolve by pattern recognition, not just of charts, but of their own behavior. They see the mistake, they feel the impulse, but they pause, they remember the cost, they choose differently. Trading is a mirror. It reflects who you are under pressure. And unless you learn to break that internal loop, this time will never actually be different. Here's the brutal truth. You can't outtrade your psychology. You can't succeed long-term with short-term emotional habits. If you saw yourself in any of these 5 traps, good. Awareness is the first step toward mastery. Subscribe if you're committed to breaking these patterns and finally trading with control. And tell me in the comments, which one of these habits held you back the most? And what are you doing to fix it? It's not about being perfect. It's about being conscious. Let's trade like professionals, not prisoners of emotion.